That's great. So I'm going to make a start with a bit of an introduction on the unit. And we've got two things that we are looking at on our screen. One, I'm going to switch between, the unit specification, which is business environment. And obviously, this particular unit, from a point of view of, when we look at accounting in particular, is slightly important. It could be slightly commissioner in the sense that most of us are aware of the various functions of why and how businesses are set up, the classification of businesses, but it's just a case of refreshing some of these bits as we go along in terms of, understanding and looking at, towards the IFA practicing membership. So from our perspective, what I want to be able to do is look at why do we study business environment and, why is it, important. So I think a couple of points here with regards to, the reason why this unit is included, in the, let's say, the accounting side of things. One is that we typically, when we work as businesses, as individuals, and look at providing professional services which are related to financial accounting. Hi, Vicky.
Hi.
Hi, how are you doing? You okay?
Yes, good, thank you.
Good stuff. I'm just starting off with a bit of an introduction on the unit. And are you able to hear me okay and see the screen clearly?
Yeah, I can, yeah.
Okay, that's brilliant. So the context of looking at, why we are looking at starting or basically looking at studying this unit would be that when we look at providing professional services, specifically related here to accounting services, we deal with a lot of individuals, different types of, way they go to market. And in some cases, what will happen is that when we look at most customers going to market, they will at some stage form an entity. And that entity would be, related to the fact in terms of how best it suits their purpose to be able to provide goods and services to their consumers or customers in this case. So when we look at, essentially they going to market and they basically looking at packaging their services around something, they would need to form an entity. And these entities could be in different shapes and formats according to legislation, according to regulation, and obviously at some stage would have some basic minimum bits of requirements to be able to, submit some documentation of the operations of the entity or the company at some stage. So business environment would be related to understanding, how do we know what is the legal remit of setting up entities. So from a point of view of companies, when we look at, so we'll get into details like, why does a business start up as a sole trader or a partnership or a limited company or a limited liability company? There are options today to look at opening up a social enterprise, a charity, cooperative. So we'll understand some part of this ownership structure of companies, which sometimes we end up advising our clients when they come into us, for seeking accountancy or financial services. Which company or company structure would be best from a point of view of operating in the business environment or the sector they operate in? Some part of our consultation and, obviously discussions with clients also tends to be related to who are going to be the stakeholders, shareholders in the company, what are the company operations going to be, how do you see the company operations expanding over a point in time? And then we are looking at, giving them some advice in terms of how to set this up, the structure, the ownership, and we're also looking at what roles and responsibilities could be assigned if the company and the setup begins to grow, and what would be the appropriate, legal and legislative guidelines which the company or the entity would need to follow. So this bit is what is important for us to understand from a, let's say, a theoretical perspective, and that's why I think business environment as a unit is, included within this accounting suite of qualifications. We will be after the first learning outcome. So this unit, if I just briefly put it this way, in terms of the reading that we will do in this unit would be broken down into 3 different learning outcomes. So the first part of the learning outcome will focus primarily on understanding, the ownership and how businesses are set up. So when we look at the first learning outcome, it is going to cover some of the assessment criteria and obviously this bit which I've just circled. Now, in the second learning outcome, we are going to be looking at understanding how internal and external factors typically affect, the workings and operations of a business. So here we are going to be looking at contextualizing some of the external factors which could affect the business, which could be things like changes in government legislation. We will also look at some of the economic side of activity, or economic trends, how do they affect business? Like we're in the middle of a pandemic, obviously lots of businesses are shut, and there is lots of help which the government has provided to small, medium and large businesses to be able to tide over this particular trying time. So we will look at some of the external factors which could affect businesses, specifically when we look at organizations which are, having businesses or operations abroad. They deal in import exports, and you would also look at businesses which would be, at different, depending on the size and scale of the operation. We will look at how some of these factors affect the business. So here we're going to be talking in particular about PEST or PESTEL, looking at one of the frameworks which talks and helps us dwell into factors like political factors, economic factors, social factors, technological factors. You look at legal and environmental factors which could affect the business, and how the businesses would look at then coping up with some of these external influences which let's say affect their operations on a day-to-day basis, or on a quarterly or a monthly or a yearly basis. And in the last learning outcome, we are going to be looking at primarily understanding and broadening our understanding on how some of these conditions can be broadly predicted. So when we look at accounting side of things and some of the basic things that we do with our clients, which is to do with things like cash flow statements, or how is the cash going to be managed, where is the business coming from, what is the income and revenue side of things for a business, then in those cases what we would look at is understanding the wider impact of the economic environment specifically related to a particular sector, and see how they affect the business and its business operations. So there's a fair bit to cover. There will be 3 sessions that we will be looking at conducting, and these 3 sessions will cover the 3 learning outcomes. After that, what we're going to be looking at doing is do a discussion on the assignment brief, and that would look at putting together the evidence to be able to try and achieve this particular unit. So in the first part, most of it that we look at, in terms of the delivery and study of this unit, we're going to be looking at some PowerPoint presentations, a few case studies, and obviously a few videos that would be used to discuss some of the indicative content which is given here. So if you look at the first learning outcome, we are going to be looking at covering most of it today, which is this is the indicative content, which is what is going to make you feel confident that, okay, when I look at different forms of legal ownership of a business, these are the bits that we need to cover so that we are able to understand what are the core concepts, terminologies, and how do we use them when we look at dealing with customers who are going to be looking at say, let's for example opening up a business or an entity at some stage and would become a client at your end. So the unit is 15 credits. We are looking at about 4 sessions. There are 3 learning outcomes. The units are graded. So obviously, if you're looking at achieving a pass, we'll go into the assignment brief later, but just a brief idea here is that if you're looking at achieving a pass, most learners will only do the pass tasks. These tasks, or these assessment criteria as we call them, would then be converted into tasks in the assignment brief. So the assignment brief would be termed as AB, and what we look at here that we are going through right now is called the US, which is unit specification. So this is going to inform specifically what is to be taught and what all do we need to learn from the overall unit perspective. And when we look at the assignment brief, all these assessment criteria that we see here will actually be converted into what are called tasks or activities, and they will test the skills and knowledge that you've acquired. So obviously knowledge that you've acquired from the study of this particular unit, and some part of these tasks and activities will be in the Q&A or question answer form that you will do as a Word document or a PowerPoint presentation. So going back to the point wherein if you're looking at achieving a pass, you'll probably end up doing only the pass activities. If you're looking at achieving pass plus merit, it will be pass activities as well as merit. And if you're looking at achieving a distinction, then obviously you'll be looking at attempting pretty much all the activities which are given in the assignment brief across the 3 learning outcomes. journal as a, just for understanding as a thumb rule, if you have 3 learning outcomes, there are going to be 3 tasks in the assignment, and most of these will relate to, the assessment criteria which are given here. So at some stage when we've gone through the whole unit, it'll be easy for you to put a context in place to say, okay, we've covered these, we've covered the indicative content, and you know what evidence has to be compiled or put together to be able to then study, the unit. Now, with regards to the basic bits on the unit itself, we will get on with regards to understanding some part of it by getting into this presentation. And I've got about 37, 38 slides. Some part of it would be to go through at your own after the session, but I'm going to be trying to cover most of the important, content of the presentation. Obviously, they tend to be quite detailed because the idea is to try and impart about 80, 85, 90% of, most of the indicative content and the knowledge which is there contained in the learning outcome using presentation videos or, some sort of discussion that we do. So feel free to ask me questions or, jump in if there are bits and pieces that we need to elaborate on or we need to discuss, and that could make the session a bit more interactive. As I mentioned to you, the wider remit is to understand the setup of ownership and legal structures when we understand, companies and companies or, the setup of companies or entities. And, these are bits and pieces that you normally would deal in or deal with essentially on a day-to-day basis when you have new clients or, obviously people coming in to get some advice to say, okay, I'm looking at starting a business and I'm looking at starting it as a sole trader or as a partnership. And that is where some of the key bits around, how the legal entity or the businesses are set up is going to be looked at in this particular unit. I've got the indicative content of the first learning outcome, which is predominantly copied and pasted from this bit here, so that, when you look at the presentation at some stage later, everything is coming from one document rather than you having to shuffle between a number of documents. Now, in terms of this particular unit, there is not much that we can look at in terms of, key terminology or key terms, essentially. One of the things that I would say is most of us are aware of that when we talk about businesses, when we talk about an entity, we basically look at identifying a few opportunities, you tap into some resources, you look at some capital, and at some stage you decide that, okay, this is something that is, I need to, if you're starting off a business or, you're starting off a venture, you basically look at setting up some sort of a legal entity, and that legal entity takes the form of some sort of a business. Now, when we look at different forms of legal entities, what we are going to be doing is classifying them into different types. And these different types would be starting with something like a sole trader, which means you have typically just the one person, maybe a small business just starting off, as a startup business. And in this case, what we generally see, sometimes people would set up, a running operation of an entity as a sole trader. And here, because the reason why this is primarily chosen in some cases is that when you look at let's say when you look at starting something off, there are lots of bits and pieces to look at. And if you visualize that if you decide to start a business, then you look at writing a business plan, you look at naming a company or choosing a name for the company, you need some startup capital that you will put in. You look at what products and services that you're going to be able to sell, or at least looking at selling. And at some stage, what you'll also look at is where will you operate from, and if it is going to be a services business, how would you procure goods and services from different locations or suppliers, and that would allow you to then sell them across onwards to your, customers. So when we look at sole trader, the reason why people end up registering or starting something off as a sole trader is because it requires a very minimal setup, both in terms of documentation, from a point of view of looking at legal side, which is, with Companies House or with HMRC, and the other thing is that because you're very unsure at this stage that you're looking at starting a business, whether you would want to continue or not continue over a point in time, sometimes you will see people set this up because of lesser complications, documentation and other bits required, which is running it because you're the only employed or the person, you're only person employed within the business, and you would see that becomes a starting point. Now, sometimes when we look at this being set up, we generally see individuals going as self-employed. You would see small businesses or, individuals which are having skills. We generally see plumbers, electricians. We see people who start off on their own on the basis of their skills, could set up something under this particular remit, and this would allow them to work as a sole trader till the business gets off the ground. And in some cases, sometimes people would then migrate from starting as a sole trader to a partnership if they expand, or to a limited company if the turnover starts to grow and the business starts to, turn over a lot of money. But generally speaking, when we talk about sole traders, minimal setup, the disadvantages tends to be that here the liability is with the owner or the director or the person who's actually starting off. So here, one of the key bits of disadvantages tends to be when you set up something like this and you start as a sole trader, you're going to be looking at an unlimited liability, which will be, sitting on the shoulders or, the shoulders of the director or the owner of the business. Now, most sole traders do a filing, towards the end of the year. They also need to file accounts, but at the end of the day, the requirements in terms of filing the accounts typically are not restricted to, looking at paying, say, for example, national insurance contributions, or you would look at, corporation tax. Here, most of the liability, most of the profit, most of the wages which are being drawn out by people as sole traders would essentially be, compiled as their own tax or as a tax for that entity, but the tax liability generally tends to be lower as compared to some of the other businesses. Now, this cannot be generalized, but in some cases there are sole traders which are trading as sole traders, like we have lots of grocery stores or shops, newspaper agents, and those kind of shops which basically start off sole traders. They have a large amount of turnover. They're churning out a lot of cash flow on a daily basis, but they still function as sole traders. But at some stage, when some of these transactions go beyond a certain threshold, obviously there is a necessity for them to be able to, move on from this type of ownership to a different ownership. The second one that we look at is partnership. Now, partnership tends to be when two or more people come together to start a business, or they're looking at combining their skill sets. You look at combining resources, and in some cases what you would see is that these partnerships normally come off or come together, and we get to see them working within what we say is let's say accounting firms, solicitor firms, and some sort of firms wherein there could be shared ownership, there could be shared responsibility, and pooling of resources could be done from a point of view of looking at driving in more business or more income. Now, in some cases, you would also see partnerships do work in all different types of sectors and businesses. And here, partnerships tend to, again, have what is called unlimited liability. And when we look at the concept of unlimited liability, what we would generally see is that because the liability from a point of view of, capital, which the owners put in initially at the start of the business, and the money they draw or the profits they make typically tend to be, within the partnership. And in this case, sometimes what happens is that you would see that this form of ownership of an entity tends to also reflect what is, on in terms of, creditors, and in terms of, the money which is primarily owed would then be the responsibility of the partners which are in the business, and they would be held liable or responsible as far as the business, if the business is owing money to its creditors, which is suppliers, partners, customers, then in those cases, they would have to bear the burden of having that liability. Now, sometimes you would also see that, lots of different types of partnerships get formed. Now, in terms of partnership and examples of partnership, do you have any specific examples that you've seen while you deal with customers? And let's put it this way: are any of your customers, working as an entity which is under a partnership or a sole trader, and you generally see that they have been working well or working well for a number of years? So, any examples on that side that you have in terms of partnership? So when you look at people coming together to run businesses, which could be 2 or more people, generally partnerships could be having at least 2 and up to 20 people as partners within the business. And these tend to be businesses which could be surgeries, for example, which are owned by practice manager and partners in terms of doctors. So doctors, dentists, we look at solicitors, we look at accounting firms. They generally tend to be formed up as a partnership. So you look at an example of a solicitor firm, say for example, you're an expert in immigration, somebody is an expert in commercial law, somebody is an expert in public law or divorce law or immigration law. What tends to happen is that most of these people, if they decide that they can work together, they will come together, form a partnership, and they will still be mutually exclusive. That means they will still be dealing with their area of expertise, but what will happen is that they will be able to pool their resources, pool their skill set and also their capabilities and become a bigger banner wherein they'll be able to attract more clients, for example, to deal with when they have different expertise available within the field of law. And the same could also apply to different types of partnerships. And sometimes what you will generally see is that when we talk about partnerships, the pooling of resources and I would say the knowledge and skill set which people are able to bring, they would then look at forming this particular entity as a partnership, and that is where the partners would work as a combined entity. And in this case, they would have the total liability or outstandings or outgoings of the company would be equally divided, or if they have a memorandum of understanding that I'm a partner in the firm, but I only look at 20% ownership. I have a partner in the firm which is 40% and a third partner which is 40%. So the liability could be decided on the basis of their internal understanding or MOUs, but generally the liability stands with all the partners in this case. Now, the most formed companies, most form of entities which are formed primarily to do business would be private limited companies. So if you look at Companies House, generally what we see is that a lot of businesses, or a lot of individuals, when they look at starting a business, they basically look at a legal entity within its own right, and that is by forming a public or a private, essentially a private limited company first. And here, the benefit of basically opening a private limited company is that the entity itself is, the company itself is a legal entity in its own rights. And what you see is that there are responsibilities of the directors or the owners of the company or shareholders of the company are going to be separated from the operations of the company. So in this case, the owner and director of the company can be the same person, but generally over a point in time, what you would normally see is that there could be multiple directors having different stakeholders or shareholdings in the company. And in those cases, what you will generally see is that the liability of the company is not the liability of the director alone. And in this case, the liability of the company could be liability of the shareholders of the company, and any unpaid debt, for example, or money which is owed to the say partner suppliers is then going to be owed as a liability with the company. And now in this case, when a private limited company is formed, there are certain regulations which they have to follow. The company has to be registered at the Companies House in England and Wales, similarly in Scotland. And what you will generally see is that accounts have to be filed once a year. In partnership and sole traders, obviously you're also required to file accounts, but here in this case, the accounts have to be filed, and depending on the size and scale of the organization or the entity, if it's a micro business and your turnover is up to 350,000, if you're a small business between 350,000 to 3.5 million, and if you're small medium enterprise, then anywhere between 3.5 million to up to 6.5 million, and then anything over 6.5 million would be a PLC or a public limited company. Now, in some cases, it is also related to the number of employees. So normally, micro entity would have 1 to 10 employees. Small business would have anywhere between 11 to 50 employees. Small medium business would have anywhere between 51 to 250 employees, and anywhere greater than 250 would fall into the classification of a PLC. So when we look at private limited companies, they are generally set up as an entity on its own. The responsibilities and the liabilities which the company carries different from the liability of or can be separated from the liability of the director and the owner of the company. And in this case, the mandatory requirement is that because the companies are required to publish accounts every year in terms of their financial activities, this creates a bit of transparency as far as the running of the operations of the company are concerned. So you normally see an AR03 form, which is filed every year with Companies House to show that the company is running in terms of its continuity. If the turnover of the company goes over 85,000, the company registers for VAT. You have different schemes on VAT, flat rate scheme. You have a standard scheme of 20%, and then the business, or in this case, the private limited company, has to produce a list of accounts, and these accounts have to be submitted to Companies House as per their financial year ending. So most companies would be looking at, Jan to December, or it could be 5th April to, 4th April, looking at the tax year. And in some cases, sometimes companies would, have financial years from the date that they are formed to the corresponding year or following year, in which, they will submit the accounts. If the company is formed on the 1st of July, their year end would be from 1st of July to 30th of June, and for which the accounts will have to be filed. Obviously, there are fines and other regulations which these companies have to meet when an entity is registered as a private limited company, because if you do not file the accounts on time, or you do not fill the AR03 form on time, then obviously companies can be slated to be struck off from the company's register. And in some cases, when late accounts are filed, you're liable to pay fines, and obviously some part of interest costs and other things could be levied by HMRC on the corporation tax. So here, companies are required to file corporation tax as well. And I think the corporation rate of corporation tax, which is 21%, or 20 or 21%, depending on the turnover of the company, will go up to, I think, 25% in 2025, as per the recent budget, which was announced, by Rishi Sunak. Now, just briefly looking at what are the requirements to form a private company. So there are some minimum requirements here. There should be at least one director who should be over the age of 16 in this case. The company must have a registered office in the UK. The company must comply with the government legislation, so which could be the Companies House Act of 2006. So the accounting standards in terms of producing financial statements, like the IAS Standard 7, any financial improprieties or inefficiencies in the accounts have to be reported. And obviously, if the company is not intended, or is not functioning or is operating, then the companies can also be made dormant. And if companies are no longer required, then companies can also be made defunct. And obviously, at this stage, there is a process through which you delist a company or close down the company operations. And if the operations are no longer required, then this all complies with some part of the government legislation. And obviously, one of the key requirements is that when you form a private limited company, there should be at least one share that should be issued at the time of incorporation. For large companies, when we talk about public limited companies, there has to be shares which have to be issued in excess of £50,000 as per the government legislation. So the difference between a private limited company, and obviously one difference on the side of the shares which are issued, generally for a public limited company or a PLC that we talk about, the shares have to be, minimum share issue which have to be issued at the time of incorporation have to be up to £50,000. Now, when we talk about the other types, which is the ones which we also include things like PLC, limited liability partnership, some of these very quickly looking at would be when we talk about a PLC here, generally you would see these are large companies or legal entities within themselves. At some stage, when private limited companies could be listed on a stock exchange, and there the classification then changes to a public limited company, because the shares of the company are owned by the members of the public. It could be businesses, it could be venture capitalists, it could be members of the public, it could be board, it could be the directors. But yes, any company at some stage when it is floated on the stock exchange or is going to trade publicly by issuing shares in the market, then that classification would change to a PLC. Now, most PLCs, when we look at, could be large private companies, and these large private companies or enterprises could be, obviously having number of employees. So when we look at the definition of businesses as per the .gov website, any company which is having more than 250 employees and a turnover of greater than 6.5 million, and assets worth to 12.5 million or something of thereabout in that region would typically be termed as a PLC. And in most cases, PLCs, when we look at, they could be privately held, but in most cases they are generally, issuing shares. And in some cases, what you look at is the shares are owned by the members of public. It could be, various people being shareholders in that company, and the company is listed on the stock exchange. Now, we also look at other forms of company and the ownership in terms of how companies are formed, legal entities are formed. One such ownership or legal entity which we look at is limited liability partnership. Now, the limited liability partnership, the main difference between this and a private limited company is that the company structure is actually limited by shares. That means the company basically would have limited shares, and here the main reason of setting this company is to generate profits. Now, sometimes you would also see that these primarily are formed by businesses or individuals wherein they are not, because one of the reasons why you form a limited liability company is that there is a difference in the taxation side of things, wherein, they are, LLPs do not need to, let's say, file for corporation tax. So sometimes you would see that here partners or people come together, they form a partnership, and obviously the tax liability of this basically is going to be done and, is going to fall on their shoulders. So any income which the company makes, any profit which the company makes is going to be dealt through by paying tax as a PAYE, or essentially, on the owners or partners side, and that would be basically done through the self-assessment route. And in this case, their income, which they are going to take from the partnership, would essentially be taxable. And that is where, these kind of businesses get formed. So sometimes you would see that here, when these kind of businesses or business structure is formed, you would normally see that there could be different types of businesses coming together, and they are trying to form a partnership to pool in resources and obviously provide services to the market. But here, the main part is that this type of a company can only be formed, or legal entity can only be formed if there are at least two partners which are to be designated as members, and they are responsible for the day-to-day running of the company. Now, in some cases, what you would see is that these designated members are also the overall decision makers in terms of running the operations of the company. So there is a way wherein sometimes you would generally see that people would look at forming this form of a partnership, and when they look at forming this type of a partnership, essentially what will happen is that they are going to be looking at, let's say, turning over the business would create a turnover essentially in let's say less than 350,000 pounds, and here they would, when I say they, I mean the legal owners would actually operate as partners because they are professionals or providing services as professionals in their own field, chosen field, and that would mean that they combine or come together to pool resources to be able to form a wider banner or a bigger banner, and that allows them to work under the partnership, limited liability partnership banner, wherein some part of the liabilities are shared by the company or the partnership which is formed, and the main part of the remit being that if the income which is coming into the company, income is taken out by the partners, then the taxation side of things on those is basically paid to HMRC through the personal income and self-tax assessment, which is done which is done for the company, wherein the company would file the tax, pay corporation tax, and the directors or the owners of the company might be drawing out dividends or salaries from the company. So when we talk about limited liability partnerships, here we generally see again, firms like, accounting practices firms, you look at solicitor firms, you look at a pool of firms which come together to offer services. So there are lots of startup businesses on the digital side. Now we look at, so find a local plumber, find a local electrician. So what has happened is there 20 people or 30 people have come together and they formed a partnership. So basically they would provide any sort of services which are required in a particular area, in a particular town or a city, but they have an overarching banner of a limited liability partnership, but most of them would provide their own services or receive inquiries from the central office, and at some stage they will be providing services in their own postcodes, but there is a bigger banner which gets formed, and that would be an example of what is called the limited liability companies. Now the key points in this case is that here some of these LLPs which are formed are primarily formed to make profits. So here they will be owned by a number of partners, but there should be at least 2 designated members because they have certain responsibility of running the day-to-day operations of the company. The partners will have limited liability, still having a bigger banner, a bigger name, but having limited liability. And in some cases, what you would also see is that because these partnership firms at some point in time, when they start turning out or churning out bigger revenue, then in those cases, they would then either migrate into becoming a PLC or migrate into becoming a private limited company. But for the most part of it, members pay tax on their personal income, and obviously they are required to file accounts. And these are, the reasons why sometimes you would see that LLPs are formed or limited liability partnerships are formed. Now, we also look at, companies which are basically sometimes labeled as company formed by guarantee. That means the company has been, a legal entity has been formed as a company, but it is limited by guarantee. That means that these companies, if they are generally set up as non-profit enterprises, and any such profits which are generated by the operations of the company are reinvested back into the company in order to, say, do greater good for the society, for charitable causes. And in some cases, when we look at, these type of entities being formed, they are called, companies limited by guarantee. So the main reason here of forming this type of legal entity is that these are generally designed to be, offering services to the community or, giving back to the community, social enterprises as we call them sometimes, and they tend to be what are generally called charitable institutions. So they are non-for-profit organizations, and here, they are limited by guarantee in terms of that there are reasons why they are formed in such a way that they are not looking at primarily making profits. And in this case, the company has a number of decision makers as against just the owners of the company. So when you look at some companies which are formed by guarantee, you would start to see that there are charities which basically start off as charities, in some cases social enterprises, or in some cases you would see companies which are created primarily for non-profit reasons or purposes. We also look at limited partnership. This is also a type of entity which could be formed, and it is an entity which is obviously registered at the company's house. It consists of 2 partners, and they are divided into either individuals or corporate entities. Here, there are 2 distinct roles that need to be defined when you form limited partnerships. So if there are at least 2 partners which have to be there, the 2 partners have to take 2 different responsibilities. One of them is called the general partner, and the other is called the limited partner. And they need to be able to, do these duties under the remit, which is general partners and limited partners. And that is where you would generally see that these type of companies also, get formed. Here, sometimes you would see the reason why limited partnerships are formed is that one of the basic reasons that we look at is if you're based in the UK and you're looking at closely working with another company which is based outside the UK, these 2 companies could have some sort of a business association which could be structured around and formalized around what is called limited partnership. And this would allow the businesses to function in different geographies, but at the same time pool their resources, pool their strengths, skill sets, and the offerings that they have, and then offer them to different customers in different locations. Obviously, the remit and the functioning of the business tends to be mutually exclusive, but legal requirements for this to be formed within the UK would mean that the company should have a registered office in the UK, And in some cases, when I say some cases, what I mean by that is that these companies which are, created, or these entities which are created as limited partnerships, they need to be able to have clear, distinct responsibilities which are divided amongst the two partners, one being the general partner and one being the limited partner. So here, in terms of liabilities, the limited partner would look into the liabilities, and the general partner would look at the day-to-day operations of the company with regards to the working in terms of the operations, whether it's in the UK or it's outside the UK, wherein the two companies are working together. Now, as against all the other companies, they're also required to essentially file accounts, and obviously the filing of accounts is done, it could be done, because the registered office is in the UK, and that's a legal requirement. So even if there is no business transaction or business which happens, these companies still need to file nil accounts and, the basic requirements that need to be met with regards to the Companies House Act of 2006. So they will need to report any sort of income which has been generated within this entity, and if that income has been generated, then they are liable to pay tax, and this tax normally is paid out to HMRC. And because it's a partnership, there is no corporation tax liability, but if that money is being drawn out by the partner or is being paid out as income, then the partners would need to file, self-assessment tax in order for, this limited partnership to be viable and obviously ongoing. I've explained the basic bits of the responsibility of the two partners. One of the questions which comes to mind is that are limited partnerships, going to be tax efficient? In some cases, you generally see that yes, they seem to be more tax efficient than a limited company because of the fact that here the companies are not paying, or partnership, entity formed under a limited partnership is actually not paying any corporation tax, and the tax liability is primarily on the basis of what the partners are able to draw out as income, and that is then reflected in the form of personal tax at the end of the year that they pay. So in some cases, we could say that limited partnerships which are formed when two different types of entities come together and they are trying to look at pooling resources, they're trying to offer services in different locations, as long as they conform to the legal guidelines of how limited partnerships are formed in the UK, they would be slightly more tax efficient because these entities do not look at paying corporation tax. One or two last ones that we look at very briefly is cooperative. Now, cooperative, generally we look at the co-op, we look at John Lewis Partnership. These are examples of cooperatives. We look at the Nationwide Building Society. Some of these organizations which are owned by a group of individuals and they're operated for their mutual benefit. That means everybody who's everyone who's the owner of they have some sort of an ownership, let's put it this way, in the entity or the business, and any such profits or any such proceeds which come out, if the company or this particular entity turns over profits, are shared with all its members. And in this case, this would be termed as this type of an entity would be termed as a cooperative. Some examples of cooperative that, we look at, we pay bills, obviously, on water and electricity. They are cooperatives. You look at Cooperative Bank. You look at some of the housing societies which are set up as cooperatives. So here, all the members or staff workers working within the organization have ownership of the business, and obviously any such proceeds or any profits which the business makes at the end of the year are shared, or the proceeds of those profits are shared with its members as far as the ownership and this is concerned. They would go through the same guidelines of filing corporation tax. They would go through the same guidelines of obviously working through the Companies Act of 2006, but it is another classification wherein a group of individuals, staff, employees, workers working within an organization also own have shares or ownership within the organization itself. The last one that we look at is charities. Now, charities are non-for-profit organizations. They could be different types. I think recently, when we look at 2015, the guidelines in terms of how charities can be set up have changed. So there are different types of charities which could be formed. There are 4 broad types, and in this case, again, the Charities Commission, essentially, which is the signature body, which basically regulates the working of charities, They are also required to file accounts. They're also required to declare how funds are generated, either from the members of public, businesses, different entities, and depending on the type and the reason why the charity is formed, they could be classified as 4 different types. So they briefly at this moment looking at, charitable incorporated organization, which is CIO. There could be a charitable company, which is limited by guarantee. You have unincorporated associations and you have trusts. So more details are available on the .gov website, but here sometimes when we look at forming a social enterprise or a enterprise which is primarily going to be for non-for-profit, wherein it is related to providing greater good to the community or returning back to the community, it involves fund generation from the members of public, businesses, other routes through which funds can be generated, then this as a requirement has to be registered as a charity with the Charities Commission in England and Wales, slightly different for Scotland. And they also go through the similar set of processes to be able to, at the end of the year, file accounts, declare, how much money has come in. And obviously, in some cases, if there are accumulation of capital and, reserves, which happens in terms of money being generated, but it is also being saved. In some cases, you would see some of these charities then become trusts. And obviously, because of the capital they control or the money they have, their classifications would have to be different in terms of how they are set up as a structure. So this part in the first bit that I've discussed actually helps us understand how we could set up entities from a different legal business ownership perspective. And sometimes when you look at people setting up businesses, looking at starting up a business, they would come in and seek advice, which would primarily be what kind of a business or a legal entity they need to set up and start up with. And sometimes our advice tends to be around that particular fact that, okay, you need to set up as a sole trader, partnership, a limited liability company, you could be a private limited company. And in some cases, if you are dealing with larger or bigger clients, which have more than 250 employees, they could be PLCs. And in some cases, it could be cooperatives and charities as well, or non-for-profit organization. So any questions on this in the first part that we've discussed? Is it clear? Are there any questions on this?
No, I haven't got any questions.
Okay, that's great. Chris, any questions at your end? Okay. So let's get on with the second criteria, which basically is going to look at focusing on business activities or different type of business activities, which business would actually, when we form the legal entity, and that legal entity, if we term that or coin that as a business, then what could be the various activities the businesses do or these legal entities do. Now, 1 or 2 quick slides just to refresh, going down memory lane when we look at our GCSEs in particular, in terms of when we talked about different types of businesses, different sectors. So there is primary sector. If you recall, we talk about secondary sector and we talk about tertiary sector. So when we look at these, essentially primary sector would be businesses which actually are looking at using, natural resources or material to be able to, generate goods and services. Secondary sector tends to be which are going to be looking at using the natural material or resources which have been extracted, and they would try and then either produce a finished product, semi-finished product, which could be used by other industries or, firms, manufacturing units to further process and refine that. And that would essentially be, the secondary sector. And the tertiary sector tends to be where we see most of the business and the consumer actually interacting. When you see grocery stores, retail stores, you go to the outlets, you go to restaurants, and essentially being served to the customer. So if I speak to somebody to take out an insurance policy, so I'm not going to be going to the Financial Conduct Authority to find out and discuss about what are the various requirements. I'll probably ring up Sheila's Wheel or, LV, Liverpool, Victoria, some sort of direct line, some sort of a company, and obviously they'll be offering that product to me directly. So in this case, this particular company would operate in the tertiary sector because they're basically providing you a finished good or a product, and they have a product already. So if you want a car insurance, you want a house insurance, you want a mortgage, they have those products which are already available. But if I talk about the secondary sector, then these could be companies which are producing, most of them could be manufacturing units, engineering companies. They are producing goods which are then going to be sold across to consumers, in the retail outlets, either through distribution, online, whichever means. And then primary sector tends to be where we are producing these goods or extracting these goods from, say, for example, the Mother Earth or the environment. So when I look at companies which are extracting diamonds, whether it's in South Africa, whether it's in Russia, other parts of the world, or you would generally see, or Rio Tinto, which is extracting coal from the ground. You see Saudi Aramco, which is extracting oil from the environment or from the ground. They would essentially be the primary sector. And this is where the classification is, just to revisit this down our memory lane as far as, our GCSEs were concerned. Now, how would we relate this to business activity? I'll come to that in a second. Now, the other bit that we look at is, depending on the sector, we look at 3 different types of businesses. So classification on the businesses tends to be today on the basis of, whether you're a service business, whether you're a merchandising business, or whether you're a manufacturing business. Now, these 3 different classifications, tend to also give us how businesses or companies are operating between primary, secondary, and tertiary sector. Now, if you're doing a combination of both, that means you're classified as a business, which is sometimes when I look at the SIC classification of activities which businesses have to choose, and they have to define at least one activity which is normally associated with a business, then what you generally see is that, the businesses have to specify when they talk about the standard industrial classification on the basis of their economic activity. And when they look at, companies being formed, or we register companies and entities, those have to be defined. So when we look at that, sometimes some of the questioning or, information that we need to seek out to understand what type of business activities with the business would be doing would be on the basis of whether you're a services business, whether you're a merchandising business, whether you're a manufacturing business. And then when we look at the UK standard of, industrial classification on the basis of economic activities, which is the SIC codes that we look at, they tend to be 9001, 7001, whatever, different categories and different codes. So if you're a restaurant, if you're serving liquor, if you're selling liquor, if you're producing liquor, or those would be the codes which would be associated on the basis of the type of business and the type of business activities. Now, along with this, we also need to understand what kind of, now if I throw in the financial bit, which is the accounting bit that we want to understand, okay, why is it important for us? So one of the points that why this business activity is important for us to understand is because at some stage we need to link this to the SIC classification of services or business, which it does. The second part is we also need to be able to understand what would be or who would be the users of financial account or the financial information being produced for this business. So for example, at the end of the year, if the accounts are submitted, you create a number of different types of financial statements, then who are these statements going to be useful for? Or who is going to be the user of this particular information? So sometimes what we also need to understand is who are going to be the key stakeholders in the business or the entity. And they would require financial information to be produced and provided to them in a particular format. So if you are looking at producing this information, when we look at producing balance sheets, profit and loss account, cash flow statements, income and expense statements, some of these would be useful for different types of stakeholders of the organization. So when we talk about different stakeholders, we look at grouping them into things like you have investors, you have lenders, you have creditors, you have customers, you have employees, you have government, you have analysts, and you have general members of public. Now, the reason of classification of the stakeholders is because we can classify these stakeholders into what are called the internal types or external types. So when I say internal stakeholders, they would be people who are working within the setup, and these could be employees, staff, owners of the company, directors of the company. And when we talk about external stakeholders, they could be partners, suppliers, customers, creditors, government, and even in general, the society. Now, the reason why we need to understand this is when we try and relate the business and its activities, some of these activities would be very specific to different types of stakeholders. Now, if I'm an investor into the firm, or if I've invested some money as an investor into a business, then I might not be interested in understanding what are the day-to-day operations or, how the company is being run, what decisions are being made. But I will be more interested in understanding how the company is actually strategizing at the end of the year to be able to achieve the objectives. What could be the profit the company would generate? What kind of dividends would I be able to get? Or what kind of return on capital that has been invested into the business would I be able to get at the end of the year? So sometimes when we look at the business activities and when we look at producing these financial statements, you would see that depending on, again, the size and scale of business, you would see that there are lots of notes which are provided in the accounts which are submitted to Companies House. And these notes would include, information on things like amortization, depreciation, dividends, bonuses, incentive policies, or assets which have been purchased, capitalization of assets which have been done, or large purchases of assets have been done wherein the capital has been invested or the company's reserves have been used. If there has been a injection of capital by the director or the owners in terms of a loan or, is it for a long-term period of providing stability to the cash flows in the state, in the company or the state of affairs into the company, then we need to understand what kind of role these people would play and who would be these when we look at the classification of them under the stakeholder. So a broader understanding to looking at, in order to understand the activities of the business, we need to be able to understand the sectors, the areas of operation, and also the stakeholders involved. Now, when we look at throwing the mix in terms of, what would be the activities of the business from an accounting perspective, from a perspective of, looking at financial activities, we would be looking at three different types. So these three different types of activities that we are interested in terms of what the business would look at from an accounting financial perspective would be activities which are related or revolving around financial activities, investment operations or activities, and operating activities which are the day-to-day running of the company. Now, some of these you get to see when we generate what are called cash flow statements. And if you recall, if you've studied financial accounting and you've looked at some part of this, and when you do the preparation of some of the income-based statements, we look at one statement which becomes very important to understand the business activities, and this tends to be the cash flow statement. And cash flow statement has three different sections in the statement. One of the sections actually corresponds to operating activities, which could be looking at, putting down all the income and expenses which are involved in production, sales, delivery, in terms of collection. If the company is into manufacturing, if the company is into servicing or providing goods and services, then they could also include things like, cost of inventory, raw material, if there are any repair costs which are coming in for the machinery, advertising, sales, marketing, all these costs which are related to the day-to-day function of the company would actually, or the entity would come into operating activities. Then we look at investment activities or investment side of things when we look at from a business operations point of view. Here we would be looking at things which will include purchases, sale of asset to generate more capital or, let's say, ease the cash flow situation. In some cases, you would see companies would sell up unused land, or if you look at the news and if you keep track of some of the news, for example, the competitions watchdogs sometimes asks Tesco's, Asda's, Morrisons, Sainsbury's to sell off locations wherein, in order to look at even competition and, look at, let's say, if you see land grabbing, say, for example, most of these large big fours have, grabbed a lot of land to be able to open retail outlets or, their stores at some point in time. But sometimes you would see that they are asked to sell these places or these locations because this would open it up to competition and also allow, smaller players to, survive in the market. So when we look at the competitions watchdog, some activities sometimes you would see companies would need to do is to generate more cash or maybe sell off assets which are not being used, and they would be then used for other investment activities within the organization. So when we talk about investment activities, we talk about purchase or sale of assets which companies could do, unrequired machinery which is not being used, plant or location which is not being used, companies would sell them off, to either pay off loans, short-term or long-term loans, and in some cases, this would be brought into by selling the unused assets of the company and brought in as capital reserves or reserves which get created in the company or the entity altogether. And then we look at financial activities. So financial activities would be essentially, money coming into the company, and this could be coming in from primarily, investors. It could primarily be activities related to money being injected by the directors in the company. It could be share issues. For example, if the company decides to list itself on a stock exchange, then the shares issue would be looking at generating money. I think in the last couple of days, we've seen Deliveroo going in and looking at, doing an initial public offering. So some of these long-term financial activities, which is long-term decision on finances, would be covered in the cash flow statements of the organizations to depict their business activities. And when we talk about long-term positioning in terms of how the cash would be coming in or the shoring up of the capital would happen within the company operations, would be covered under financial activities. And to give an example, if we look at just as an example of where these activities are, reflected, when we talk about different types of business activities which could be seen from a financial perspective, from an accounting perspective. So we look at a cash flow statement, and as you can see, they are divided into three different distinct parts. So operating activities, investing activities, and financial activities, and they inform us about the information or key bits of the information which are required to understand whether the business is viable, whether the business is generating enough cash, is there enough income coming in to manage all the expenses? Expenses could be salaries, wages, or rental costs and things like that. But they are all reflected. This is a snapshot of a cash flow statement, but generally they would be quite detailed, and they would essentially allow us to understand what are the business activities which the company or the entity is actually going into. Let me just quickly try and see if we can pull out one, example of a cash flow statement, a simple one to show this in a bit more detail, just visually. So looking at a sample cash flow statement, and if I just switch this over now from our point of view to show you a cash flow statement. If you look at this, this is an example of a cash flow statement for a Man and Man Limited, which is a sole trader or a small private limited company here. And what we look at is the business is a startup business. So if it's going to start up, somebody has drawn up a cash flow statement just to look at, what are the places in which the company would actually be spending money, where the money would be coming from, and what money would be utilized, in the day-to-day activities which are happening within the company. So if this company is to be formed, somebody's done a cash flow statement, and in this case, as you see the opening balance is zero, money coming in, money going out. Now, if I have to separate this into three different sections, what I would be looking at is anything which is to do with operating activities, which is things like, loan costs, advertising. This would be the operating activities in the cash flow statement. When I look at investment activities, so anything which is coming in as money, into the business, which is primarily coming across from either a bank loan or owner's initial capital seed fund, which is being put in, the money the owner is putting in would actually be, I would say, investment activities. At the end of the year, any dividends, salaries which are going to be taken out or on a monthly basis going to be taken out are also going to be related to investment activities. And then we look at this will be related to what are called the investing activities. And when I look at financial activities, anything which is looking at paying the loan interest cost, looking at overdraft costs which could be wherein the owner here is buying, say, for example, a new vehicle on a hire purchase. He starts off with one van, but he looks at hiring another one. So they would be looking at, financial activities, and some part of this would correlate into investment activities. So from a cash flow statement, we are able to get a very good idea in terms of what the company activities or the business activities are. And sometimes when we look at it from a financial perspective, our aim is to understand, these activities from a point of view of, looking at the basic bits, which is to say that, okay, the business is having three different forms of activities. These activities could be operating. These activities could be investing, and the last activity could be financial side. Any questions on this so far?
No, nothing for me.
Okay. Let's look at briefly now the assessment criteria, which is 1.3, which talks about we need to generally look at and understanding what are the organizational responsibilities when we have a business or when we have an entity which is running. Now, this is slightly broad-based in terms of looking at what could be the responsibilities of an organization, but from an accounting perspective, again, and just to understand this generally, what I've done is looked at a couple of things. Now, when we talk about different responsibilities which a company or an entity needs to fulfill, these responsibilities can be divided or could be towards social, environmental, financial, corporate. It could be ethical responsibilities. Now, when we talk about these responsibilities in general, there could be responsibilities also towards the stakeholders, which we've looked at earlier, which could be employees. It could be the government, legislative part of things, which is to ensure that they are meeting all the requirements on the legislation side. So here, in this particular task, because it talks about analysis, so what we need to be able to do is put a lot of arguments together to say these are the various different types of responsibilities that an organization or an entity or a business needs to fulfill, and they could be attributed towards what are called corporate responsibilities, financial responsibilities, social responsibilities, environmental responsibilities, and off late what we get to hear. When I say off late, what I mean by that is from the 1990s, we also get to hear what is called the corporate social responsibility, which could be different types of responsibilities like being carbon neutral, sustainability, looking at environmental friendliness, wastage and recycling, waste disposal. These are all such ethical responsibilities which are now also associated with organizational responsibilities. Now, in order to put this into perspective and we look at diving into a bit more specific, one of the key bits that you need to be aware of is this is what is called the triple bottom line concept. So here, this concept essentially talks about companies being responsible towards people, environment, and also their key stakeholders. So with this particular concept was introduced by John Elkington. He was a British business consultant who was doing consulting for a lot of American companies. And in the 1990s, he came up with this idea that all organizations need to have what is called, responsibilities towards three different, facets of their business. And when we talked about that, he came up with this particular theory, which was then accepted, that businesses have to, when an entity does business or does it for profit purposes, they have to do it in such a way that they are going to be looking at preserving the planet. If they make profits, the profits have to be sustainable, they have to be made ethically, and if they are looking at, making profits and the company is doing well, then the companies also need to share the proceeds of those profits with people, and that is where this 3P concept came about, and that's why it's called the triple bottom line. So planet, profit, and people. And as in general, the TBL concept basically is now related to corporate social responsibility in most organizations, and their responsibility related to the environment, their employees, and also their, when I say environment is planet, employees would mean people, and when I say profit means their different stakeholders. Now, there are lots of different laws and legislation that we also need to look at, that we should be aware of and have the knowledge about when we talk about, organizational responsibilities. So a lot of laws which are related to, let's say, running operations in a company, some of them can be classified as what we call the employment laws. Now, these laws include laws like these, which are basically the Employment Rights Act. We look at National Minimum Wage Act. We look at Employee Relations Act. We look at Part-Time Workers Regulation Act. We look at the Maternity and Paternal Leave Regulation, which was introduced in 1999. There are other acts which include Transfer of Undertakings Regulation 2006, the Equality Act of 2010, and the Agency Workers Regulation Act of 2010. Now, these are all in the employment side of things. most important and most frequently that we use is when we set up a payroll for a company, sole trader, partnership. We need to be looking at conforming with some of this basic employment legislation. So when you look at, employment legislation, there's a contract issued. Sometimes, as accounting firms or practices, we also look at doing payrolls. We also look at doing some part of the HR side of activities. So when you look at large companies like the Peninsula Group, they would normally be HR consultants, but also end up doing accounting activities. And when you do such practices together, some part of it is that you should be aware of the organizational responsibilities, because when you set up the payroll, things like the national minimum wage has to be looked at, so that when you're setting something up, there is a payroll being generated. We're ensuring that, the payroll is as per the National Minimum Wage Act, which has been defined. So you have a lot of companies are today employing apprentices between, 16 to 19, and anybody from 19 to 24, and mature workers. I think the minimum wage has gone up in this budget from, I think, 876 to 891, if I remember correctly. So £8.91. So essentially, those are the bits that we need to be looking at when we look at organizational responsibilities. Some part of this is when you look at employment contracts, they would need to include things like the minimum pension, which needs to be paid by contributory pension scheme, which employers have to provide an option to the employees, and they have to opt in, and the company contributions are 3% minimum, which was obviously introduced as nest pensions, I think, in 2015, and there was a phased out plan introduced. So these are some of the bits of legislation that we need to comply with when we look at organizational responsibilities. Then we look at some of the basic acts which we need to be aware of, but might not be directly usable when we talk about, the accounting practices. But if you are setting up or doing accounts for a business which is a trading business, and in some cases, some part of the notes that we produce in the statements which are submitted to Companies House at the end of the year would also look at conforming to some of these basic acts, which could be, the Consumer Credit Act, it could be the Consumer Rights Acts, it could be the Late Payment or Commercial Debt Act. For example, if you have a large customer and the large customer has many partners and suppliers, and if they owe money, and if there are contracts in place which basically define that late payments, if they are done, then there are interest costs which could be recoverable by the company. So in those cases, when they apply those interest costs and try and recover them, they are primarily a part and parcel of the Late Payment Commercial Debt Interest Act, which is of 1998. So in this case, it is defined that, they could charge the Bank of England base rate plus 8% interest cost to be recovered if there are goods and services which are delayed, or if they are, not delivered in time, or obviously, the payment for those services are not happening on time, then the late payments can be recovered using this particular act. And there are one or two other acts which could also be, just for general knowledge purposes at this stage, could be included in the organizational responsibilities. Is that if a business is a merchant business, if it's a business which is a services business, trading business, and they are trading goods and, selling goods, then the Trade Descriptions Act and the Unfair Contract Act basically also has to be, implemented and conformed to, because it is an offense under this particular act to sell products or services which are being missold, or the description of the goods are inappropriate or different from what the customers actually receive. So some part of it could be that they're advertising on the website with a code and a picture and a description of it, but when it gets delivered, obviously it is not meeting these guidelines, or the guidelines with which they have advertised or highlighted the advantages of the product. So in this case, misinformation is there. And the other bit tends to be when we look at the unfair terms in consumer contracts. Sometimes you have hidden clauses or finer prints, as we call them, terms and conditions. So in some cases, if these terms and conditions are not explained, so sometimes when we see that when you're on the phone, with the banks and a couple of other types of organizations, what they normally do is they will read out a particular statement to you to say that, okay, this is something which is a part of the policy. When you take out insurance for a car, or, for different types of products, they would read out some basic minimum guidelines to you. And then some of these contracts would also have a cooling off period of 14 days should you decide to cancel. then these are all covered under the unfair terms in the Consumer Contract Regulations Act of 1999, and they all have to be conformed with when we talk about organizational responsibilities. So in this particular task, we are basically looking at making ourselves aware of, the various laws, the minimum requirements in terms of regulation which the businesses have to follow, and we need to understand this from a point of view of looking at a lot of acts which, depending on the size and scale of business, the type of entity which is registered, they would need to follow basis the activities that they have in terms of, selling their goods or services to consumers. Is that okay? Any questions on this particular assessment criteria? Okay, good stuff. We'll be looking at one or two, bits in terms of the merit criteria. Now, the merit criteria is going to talk about looking at advantages and disadvantages of a partnership versus a limited company. Now, there was a bit of an emphasis that I paid on talking when I talked about limited partnerships, LLPs, and we talked about limited liability companies. So here in this merit task, in order to achieve a merit, what we are trying to do is basically extend that part of the ownership classification of the businesses to understand what are the advantages and disadvantages of setting up a company as a partnership, or setting up an entity as a partnership, or setting up an entity as a limited company, and we need to be able to basically put across some advantages and disadvantages. So here, just a brief recap has to be done, but what we need to be able to do is basically talk about the advantages of why a partnership is suitable, by giving an example, and in some cases, what are the disadvantages of partnership. And we need to talk about, again, the advantages of a private company versus the disadvantages of setting operations of an entity as a private company. So what I've done is I've used the table to primarily describe the advantages and disadvantages. They're quite self-explanatory in terms of why you would need to set up an entity as a private limited company, and then what are the advantages the business would have or the entity would have, and what are the disadvantages. Some part of this, if you look at, I have also put across, as some keywords in these slides when we talked about limited liability partnership. So they are profit-driven, minimum 2 members, they have limited liability, and we've talked about private limited company. We talked about limited liability and transparency, and these were advantages. So on the flip side, what we've discussed in the merit task is primarily elaborating on the disadvantages that you would normally see if you're setting up an entity as a partnership and setting up as an entity as a private limited company. So this will help accomplish the merit criteria for this particular task. Any questions on this and the session today? So with this, obviously, we've come to an end today with discussing, the first learning outcome, which is what we intended to start. We intended to study. So we looked at different types of legal ownership of businesses, and we've addressed all the assessment criteria in the first learning outcome by looking at, going through this presentation. So any questions on today's session and the presentation? Okay, good stuff. So I'll get a copy of this presentation and obviously the recording put up on Moodle, which should be up there shortly. And then we'll catch up next week with regards to, covering the second learning outcome for this particular unit and go forward on our, journey to cover this particular unit. If you think of any questions at any given stage, or if you need anything specifically to this unit, you can email me at raman@ukversity.co.uk, and I can come back to you pretty much with some additional reading material or, essentially any requirements that you would have or questions that you would have specifically for what we have covered today. Thanks so much for attending, and I'll catch up with you next week. Hopefully, the idea would be to try and have a bit more interaction. I know, Chris, at your end, you mentioned, but if the time is going to be not suitable, we can shift something around slightly, half an hour there or, earlier or later, keeping in mind the clocks went forward today. Even I was caught a bit surprised, obviously only realized it a bit later that